Good morning, everybody. Kirk Spano, pre-recorded version of Retirement Income Options and Stocks of the Week for September 19th, 2022. I am pre-recording because I'm meeting with three different investor groups today, two private equity firms and a large institutional investor that I have contracted with in the past to do some consulting. These are all part of my channel checks, part of my downline, who I share information with, who pays me to tell them what I think, which is, a nice way to get paid. And I just want to go over what I wrote this weekend for you. It really talks about how the Fed could cause stagflation next. And I'm just going to breeze through it. I expect that you'll read it at one of the websites. Right now, the punditry believe that the Federal Reserve erred on not withdrawing monetary stimulus fast enough. As you know, I'm not one of those people. I think that the Federal Reserve kept the stimulus just about the right length of time. I believe that because the baby boomer bust is coming, and we really need to stimulate clean energy development, some more natural gas development, and the massive moving of supply chains. Too tight financial conditions would stymie those efforts and thrust us into that stagflationary scarcity period that I'm afraid of, and that I've been afraid of since 2017, when I saw that we started screwing up the energy system and the trade system and supply chains with policy in the last administration that really set the stage, according to Gary Cohen and many others, not just me, for what we're experiencing now. So hopefully the Federal Reserve doesn't tighten too much. Hopefully they don't put us into a deeper hole than what we possibly could see here in the next few months. Now, the data proves that energy prices are the number one component of inflation. That's really on Saudi Arabia and now Russia with their war in the Ukraine. So to bring energy prices down, which would bring inflation down, you would need factors beyond the Federal Reserve's ability to move things other than the potential that they cause a recession. Well, in a recession, we'll have higher unemployment, and sure, inflation would come down, but at what cost? And would that inflation come down enough to really ease the pain on consumers, especially those that were now unemployed again? So the Federal Reserve could create kind of a double whammy for the economy, and that would be to make energy production harder by tightening the monetary spigot, as well as hurt employment. And I think they're fighting the two wrong battles if that's what they try to do. Now, I understand from reports that I've read that Chairman Powell is fancying himself as a modern day Paul Volcker. I don't think he's thinking about it right. If he comes in here guns blazing again on Wednesday, and he's hawkish on top of a 75 basis point rate hike, then I think that we are setting up for a collapse that potentially goes well below my base case. My base case, of course, is that we test the double bottom. I talked about that last week. But my other case is that we, in fact, test the Armageddon zombie apocalypse zone, or Jeremy Grantham zone. Now, why could that happen? If we suck so much liquidity out of the system, a combination of quantitative tightening plus rising rates, something will probably break. And if something breaks, the domino or spiral impact down could be dramatic. Now, again, it's not my base case that happens. We'll find out Wednesday, I think, what the Federal Reserve intends to do. Maybe this is their last hawkish move to get their corrections, to get everything in place for a pause or a pivot later this year. Hard to know. When manipulators manipulate, it is almost impossible to know what they're going to do next. I think it's easy to see that the Fed could be looking for one last kick into the inflation gut, with the idea that in a few months, December probably, they'd be able to pause. And if that's the case, then it is the height of manipulation. Is it good? Is it bad? Is it right? Is it wrong? At some point, you just stop asking why they do things from the standpoint of right and wrong. And you ask yourself, why do they do things from the standpoint of whose money are they really manipulating? And how are they benefiting? Remember, the banks own the Federal Reserve. And remember, the super wealthy love to buy when things are extremely cheap. The whole rinse and repeat. Buy low, sell high, sit around for a while, and wait for low to come back, then buy again. Not much of a conspiracy guy, but the fact that that happens over and over and over again and has for probably forever, at least in the case of markets, should be an instructive lesson to us. And if we're really going to be good investors, we're just going to follow the money. And right now, big money is doing interesting things. Let's take a look at what could happen with inflation and what the warning signals are. Kathy Wood, who, while not being a great trader, makes some pretty astute observations. Falling car prices could mean trouble for the car makers, at least in the short term. It's also putting downward pressure on inflation, which is why my thesis was the Fed shouldn't really raise 75 basis points or a point on Wednesday. I was in line with Jeffrey Gundlach, who said a quarter point. I think that probably makes sense in the larger scope. But again, if the Fed's goal is to see a large stock market correction so that everything can reset and clear, then there you have it. It's not about right and wrong, good and bad. It's about a different goal. Those are the things that I think we need to really think through. Who does the Fed really work for? The working person or somebody else? I think it's probably somebody else. Last week on Forex Analytics, I said that the dollar will probably start to fall soon. I don't think that's probably for another month or two, but we'll see. Could be later this week if the Fed isn't as hawkish as people think. Of course, Shooter was way up on this one. Posted another trade, showed a chart that said, look, if we break above 112.17, probably go all the way to 117, and that's probably the peak. If we close below 112.17 today, then the correction probably has begun, at least the first wave of the correction. Again, I talked about a lot of this last week. One of the things I said was that earnings were probably going to disappoint. And here we have an article on Bloomberg saying the same thing, again, a week or two after I said it. More earnings disasters like FedEx may be lurking. Suddenly, everybody thinks that the stock market is going to test the June lows. Oh my, who said that a while back? Look, I'm not trying to just ask for props here. What I'm trying to tell you is that we are generally ahead of the market. And it's because we're not buying into the trader narratives of the day. We're looking forward, not backwards. And if you really want to win, that's what you need to do. Look a little bit forward. We talked about that last week too. Have a good long-term outlook, then use the short term to find your opportunities to buy cheap. So pretty binary event is, when does the Fed decide that it's time to pause or pivot? I encourage you to read John Authors. He used to be at the Financial Times, and now he's on Bloomberg, and he's really quite good. Great addition to Bloomberg. Read this article. Then read my thesis from this week, which is that I believe that the Fed should only raise 25 basis points on Wednesday. They won't. They're going to raise more. And then pause in December. I still think that that's in play. Then again, Jerome Powell isn't calling me. What do I like to invest in right now? Well, if we consider the part of this whole clearing that I mentioned a few minutes ago has to do with the treasury market as well as the stock market, then there are a couple of things that are probably going to happen in the not too distant future that will drive the corrections and the pivots in different asset classes. What asset classes could pivot? Well, I think the first thing that we can expect is that real estate probably bottoms over the winter. But I don't think it's going to firm up for at least another year and a half. So from sometime this coming winter to the following winter, you're going to get a good opportunity to buy real estate. And that's going to include REITs. And if you're an accredited investor, you're going to want to buy some limited partnerships. One of the limited partnerships that I looked at recently, family office, small investors, just getting involved with regional projects, guaranteeing 10% incomes plus capital gains are very likely. So when people talk to you about REITs with their 4, 5, 6% dividend yields, or they show you a high yield REIT at 7, 8, 9, 10, you need to really examine what your guarantees are and how well backed you are with the real estate. What does CapEx look going forward? We just saw Store Capital get bought out by a private equity firm. Why did that happen? It's because, as I was telling you for a couple of months, and in fact, I alerted you to my thoughts on Store Capital about a week before they got bought out, was that they were going to have a hard time with CapEx improvements on their property. And that's why they sold. It's because they knew that they needed more money to fix up the properties that weren't performing the way they thought they would. Warren Buffett just sold out of Store Capital. This story of REITs that are short on cash in a higher interest rate environment is going to become very prevalent the next year. And the idea that some of the pundits and some of the writers on Seeking Alpha and elsewhere are throwing out there that the REITs are somehow a safe haven is just plainly wrong. Take a look at what the prices they got in 2020, in 2018, and 2016, and during the financial crisis. There's only two categories of REITs that I really like, and then there's an outlier that I like as well. So if you're going to look to invest in real estate, you need to think beyond, oh, well, this one did well in the past. And look at a longer term chart instead. Simon Capital, it's just a boom and bust company. They've made a ton of money for the Simons, but the average investor hasn't done that well, barely beating inflation over 20 years. And inflation was low most of the time, until recently. So you need to think through what's really going on. And these firms that I'm talking to this afternoon, they're big commercial real estate investors. I know this story pretty well. I've been talking to you about real estate for a few years now and how I look at it and why I want to buy it and how I want to buy it. And the whole REIT story, for the most part, that gets peddled is wrong. It's a lot like the gold story is mostly wrong. But you tell something to people enough times, they start to buy in, right or wrong. They get brainwashed. So if you want REITs, you need to be thinking about much lower prices than you're seeing today in most cases. Where else can we see a pivot? I think Bitcoin probably going to pivot pretty soon. Ethereum too. They've both corrected again, and they have a big move coming. Might be one more leg down, but you should be scaling into Bitcoin and Ethereum. I've told you the story, told you the reasons over and over again. Bitcoin is a store of value that the wealthy are accumulating, and Ethereum is going to be the backbone of digital contracts. And now that it uses 99% less energy, it's a big deal. This is one of the ETFs that we like. You can sell puts on this one. I'd say sell $5 or $6 puts, different months, collect your premium. This 5-6 range is where you probably need to accumulate. Even if it drops 10% more, it's only down to 5. So let's go back to gold. A few years ago, I said there was a bull market in gold coming, and gold went up, and so did gold stocks. And then they came back down. Price of gold is coming down right now. Looks like it should be pretty firm, somewhere between 1,200 and 1,500. Hard to know exactly. We should always remember with gold that it costs around $1,000 an ounce to get it out of the ground. And that price is going up, which is why I don't like the miners. And I've been telling you, buy these little gold bars or gold coins or gold heirloom jewelry. It's going to become more and more valuable. I might even trade a gold ETF in the not too distant future, waiting for a price. Remember, gold isn't money, but it's finite. It's valuable for various reasons, and it probably goes up in price in line with long-term inflation globally, but also just developing scarcity. What else is going on? Saw this headline: NextEra Energy bought a sewer system. Why? Well, one, water, as I've told you over and over again, as we've discussed over and over again, is becoming more and more scarce. But also, these clean energy utility companies, they'd really prefer that over half of their revenue come from regulated utilities. NextEra had fallen below that, down to about 43%. So buying this utility was a way to get some regulated revenue. And they paid up dearly for it. They paid 21 times revenue, which is high. That's like a technology premium. But they know that as they put money into that sewer system, they're going to get higher rates. And I think that almost everybody in America is going to see higher water and sewer rates in the not too distant future. And in fact, I think it might be one of the highest inflationary things out there over the next generation. So if you're in a part of the country, Phoenix, that has a hard time with water to begin with, you should expect your water prices to probably triple in the next decade, if not more. And I hear silly stories about, well, we're just going to pipe in water from the Great Lakes. Right. A, Canada's not going to let you. And B, even people like me would try to stop that from happening. You want water? Build a desalination plant and a pipeline, and it'll cost you. What else is going on? Tesla opening up his EV charging network. I'm sure Ford will follow suit, so will GM. Why? Because there's money from the federal government to do it. Follow the money. Luke Walton's family accelerating their impact investing push, just like the Rockefellers did. Follow the money. And if nothing else works for you, well, maybe you, like Doug Cass, can buy a little bit more marijuana. Get a little high as you watch things go by. But you do know that we've looked at YOLO, which contains MSOS, and MSOS is what I'm pivoting to because I think the American opportunity is the one that's probably the biggest. So we screen for stocks to write cash secured puts on. We take a look at what's oversold. And it's very similar to what was oversold last week and the week before. We have our satellite basket. Intel is there. Ginkgo Bioworks is there. Coinbase, which we never really invested in just because we didn't quite understand how to value it, is there. Teladoc is close to there. Some other companies that we follow are there. Some of the companies you'll see on here, if you're a reader, you know which ones we like. Interesting stuff. And if they all drop another 10 to 20%, then they're all going to be oversold on this long-term monthly chart. So we're getting close to a bottom in the market. Could happen in October, November, December. It's going to happen soon. Downward momentum, once it picks up again, is going to be pretty dramatic, especially if that's what the Fed wants. With the dollar peaking, we know that emerging markets are getting crushed. We're close to a bottom on emerging markets. Small caps haven't completely collapsed, but I think that this would be one of my very favorite holdings if I can get a price way down here in the 30s, the emerging market small cap index. I'm just going to finish with a thought about Russia. The pressure on Vladimir Putin is really, really intensifying. I don't think that he's in power by the end of next year. He could hold on a little bit longer, but I think Putin's days are numbered. And if the right wingers take control, then really bad things happen to the world. But if the moderates, who seem to outnumber the right wingers about 3 or 4 to 1, take control, then we're going to want to be one of the very first investors to get back into Russia. Russian investments are down 90% plus. We're not allowed to buy many of them, and I'm looking for backdoor ways. When Russia tries to get back into the international community because they have different leadership, it might be one of the best buy low opportunities in the history of mankind. You might be looking at an index that goes up 7, 8, 9, 10-fold. An index, not to mention certain stocks probably go up 100-fold. To keep it in the very back of your mind that when Russian leadership changes, if it changes towards the moderates, that might be the buy opportunity of the century. All right. So what I'm going to do here is I'm going to write the retirement income options tomorrow morning. I still have this huge dump on stocks of the week, so I'll probably just break that into multiple pieces. Really like what we're looking at for our investment basket. At this point, over the next few months, we're just looking to finish up scaling in. It looks like the market's going to give us that chance. So it looks like the Federal Reserve is going to make another mistake or a mistake. I don't know. Who knows? They might just be executing their game plan without telling us what the game plan was. The Fed might have lied to us. Go figure. All right. I'll catch you later this week on Thursday. Keep an eye out for the articles. I am still doing a little bit of grandpa duty this week, but I will be on top of this because if the Fed does something unexpected on Wednesday, we're going to have to really think it through. I don't think there's a lot of upside regardless of what they do because of the earnings picture. It's just a matter of what is the shape of this correction, and we'll know when we know. All right, everybody, have a good day.